Shell and Exxon are going to make money on average from Robinhood and USO people who can't trade in the spot market. That's going to tend to increase spot traders' welfare. However, spot traders also create non-fundamental risk for each other based on everyone making the price noisy. If the second force wins out, even spot traders are harmed by manipulation. So the amount they extract as a group from pure contract holders doesn't compensate for the additional risk they expose everyone to. They're kind of stuck in a prisoner's dilemma where everyone's trying to manipulate that harms all the other spot traders, and they can't commit not to doing it. So without going into the details of these graphs, this is an example where basically in equilibrium, the spot traders achieve welfare, which is lower than what they would if everyone did competitively. So basically the prisoner's dilemma is bad enough that nobody is better off. They're making things risky for the pure hedgers, and they're also making things riskier for themselves. And the other thing basically that these graphs show is that suppose that a planner could implement a kind of constrained second best. So suppose the planner can't do anything in spot markets. This is like, say, the CFTC. This is someone who basically, spot markets are somewhat outside their jurisdiction, but they can regulate contract markets. Like they can impose position limits in contract markets. What I show is basically that spot traders may in some cases prefer that everyone holds smaller contract positions. So if everyone could walk into a room and make a deal that says, we're all gonna hold sort of buy less contracts per unit factor exposure, that may make all spot traders better off. I show in the paper that that also makes all hedgers better off. So this kind of justifies regulatory intervention in these markets. Market outcomes under manipulation can be Pareto dominated. Regulators, even with a limited toolkit, can improve this basically by just telling everyone to hold less contract positions. Regulators do this in practice. They impose position limits on the size of agents' contract positions. I believe this is the first paper to show basically that here's an instance in which these position limits can actually be Pareto improved. I will skip this part for reasons of time. So the summary of the theory is basically that here's an internally consistent model of manipulation, how it affects behavior, how it affects welfare. It can be bad in the sense that it produces Pareto-dominated outcomes, and regulators can produce Pareto improvements in some settings by forcing everyone to hold smaller contract positions. The other thing that the model gives, which is useful, that I'll talk about in the remaining 5 minutes or so I have, is the model gives, okay, so first thing, what does the theory do? So far, there's disagreement in the literature on whether this thing should be regulated at all. So the theory basically says, here is a model in which this should be regulated. There is a market failure that regulation can help fix. Second question, how do we tell how bad manipulation is in any given market? Measuring welfare for spot traders empirically is fairly complicated. There's a lot of parameters involved. However, measuring welfare losses for pure hedgers, so USO, Robinhood, sort of the agents who buy contracts but don't buy things in the spot market, that's actually fairly simple. You can isolate two sources of welfare losses that agents face. So pure hedgers lose welfare because prices are risky. So there's a variance of the settlement price around the risk factor. That we can get an expression for in the baseline model. Pure hedgers also lose because the price is correlated with spot traders' contract positions. So there's a net transfer from hedgers to spot traders on average. You can also derive an expression for that in the baseline model. Baseline model is fairly unrealistic. We can add a lot more realism to the model. So we can add a lot of asymmetries. So in a generalized spot market model I study, I allow the spot traders to be different size. So some oil traders are bigger than others. I allow the spot traders to have inventory shocks. So then spot traders might not only buy oil because they have derivative contracts. They want to push prices. They have some fundamental motives to buy oil as well. And I also allow your contract positions and inventory shocks to be arbitrarily correlated as long as second moments are all finite. I show basically that the nice thing about these risk metrics, basis risk and manipulation rents, is that in the general model, there are fairly simple expressions for both of these. So there's a unique equilibrium in the general model, building on working paper, building on an old result by Du and Zhu in 2012. And then we can calculate basis risk and manipulation rents using fairly simple functions of certain objects. What are these objects? Two things that a regulator needs to observe in order to measure basis risk and manipulation rents in data. You need to measure the covariance matrices of spot traders' contract and inventory positions. So in principle, regulators observe contract positions in many markets. In some markets, they also observe at least trades, and you could estimate inventory positions. In principle, in those markets, a regulator could estimate sort of what is the variance of an agent's contract position? Do Shell and Exxon tend to have positively or negatively correlated contract positions? Then we need agents' bid slopes. So this is basically used to measure their risk capacities or their holding capacities for the spot asset. So in some markets, like the market I'm going to talk about in the next minute or two, you can estimate these from auction bidding data. But basically, if you can observe these two things, which are at least in principle observable in many markets, you can calculate two summary statistics that allow you to calculate, in the context of the model, all of the welfare losses that manipulation induces for hedgers. Okay. In the few minutes I have left, I'm going to look at the London gold price and basically use this as a testing lab to estimate my two risk metrics. Why am I using this? Basically because it's set in an auction. I observe auction bidding data, and so sort of that allows me to estimate bid slopes and thus estimate my metrics. So I'm going to do basically an out-of-sample counterfactual, which is the London gold price liquid enough and competitive enough that it can be used to cash settle COMEX gold futures contracts. COMEX gold futures contracts are currently settled by physical delivery. So just to emphasize, this is totally an out-of-sample counterfactual. Okay, why can I estimate bid slopes here? This is a dynamic price setting mechanism. It is not a dynamic auction. So it's basically a Walrasian auction where the auctioneer announces a price. Everyone says how much they want to buy and sell. If buy volume is over sell volume, the auctioneer changes the price and so on until convergence. Nice thing about this, you can prove that there exists an equilibrium in this game equivalent to the static bid submission. So what am I going to do? I'm going to assume that people are playing this static bid submission game. And the thing is, this allows me to estimate bid slopes. More details about the data are in the paper, but it's 502 auctions. I observe in every round price, buy and sell volume, and the participant count. Very quickly, the basic thing that I do is within each auction, if the round price is high relative to the price the auction ultimately clears at, there is going to be less buying and more selling. The round price is low, there's more buying, more selling, and vice versa. And then so in the context of the model, you simply run a regression through this cloud for every auction, and then you identify the bid slope in that auction. I don't observe that much data, so there are a lot of things that I have to fill in. The paper documents a process where I basically try and adopt different assumptions for every piece of uncertainty and calculate upper and lower bounds for what my two metrics, manipulation rents and basis risk, would be across all sources of uncertainty. But basically my results are that I get wide bounds, but informative bounds on both metrics. I can tell you basically that manipulation, if agents held contract positions half the COMEX position limit, would add noise to auction settlement prices between $1 to $10 US an ounce. $10 US an ounce is non-trivial relative to gold volatility of $67 a month. But the variance ratio is still relatively low. Sort of at my upper bound implies that noise caused by manipulation would be something like 2% of factor risk month over month. Manipulation rents are fairly trivial. They're sort of non-trivial in absolute terms, but per contract held by hedgers, there's something like 2 basis points of total exposure. So it's like comparable to bid-ask spreads. So what is the empirical application trying to show? With even fairly limited data, we can estimate informative bounds, and I can literally tell you, given the size of contract positions and the structure of spot markets, how much does manipulation distort market outcomes and harm hedgers in relatively, I think, intuitive terms. So this is sort of somewhat a demonstration of how these empirical tools work. I am essentially out of time. So to conclude, what have I done? 2 main contributions. I've constructed a theoretical motivation for sort of trying to clear up some of the confusion in this space about how manipulation is a market failure, can be Pareto dominated, and regulation can fix it. And then I've designed empirical metrics to measure how bad manipulation is in any given market. If a regulator sees these are bad, they can go and tighten position limits, try and redesign the benchmark, help the market. If it's good, the regulators can basically take a more hands-off approach, as manipulation isn't likely to be that bad. So the hope is that these kinds of tools can help help regulators take a more structural and more systematic approach to regulating this classic problem of manipulation in derivative markets. Thanks. Sorry for going a bit over time.
Thanks so much, Anthony. And now I'm handing it over to Sophie.
Thank you very much. So let me share my screen. Oops. Sorry. You have to find it and I'm not. Okay. So can you hear me well? Okay, so thanks a lot for this presentation. It was very clear. So what is the key idea of the paper in a nutshell? Even if it's costly, traders may have incentive to manipulate the price of the underlying asset, which is used as a reference price to compute their profit if they have a position in derivatives. Obviously, this is not new. We have heard of many scandals like the LIBOR scandal or the Forex scandal, to quote a few, in which some traders having position in derivative had attempted to manipulate the price on the spot market. So what this paper does is first tries to formalize this cost-benefit trade-off for the speculators or for the spot traders. And the key friction that it's going to introduce is imperfect competition in the spot market. And then there is a very nice application on the COMEX gold futures to try to quantify a bit and provide some economic magnitude of the extent of manipulation in an example. So the paper is very original, obviously tackles a very important issues. And what is nice is really that it provides a framework that is both normative and positive. It may guide market and product design. So to summarize the key results, the idea is that what you have on the top of my slides is the bid function of these traders on the spot market. There are two elements in this bid function. The first element number one, is the fact that traders are going to shade their bids because they anticipate their price impact. This is coming from imperfect competition. And the second component here, the number two, is the idea that by contrast to what you would expect, they take into account their position in derivative contracts when deciding on how to bid on the spot market. Okay, and so this P minus C, this is the extent of the manipulation induced basis risk. So from this bid function, you can learn two different types of things. The first thing that you can infer is that you can compute the welfare of the different participants in the market. And what is going to be very important for welfare is not only the fact that because of speculation, there is a transfer from the hedger to the speculators, okay, that we know. If speculators or spot traders, they gain more, somebody has to lose. But what is really crucial in order to decide whether to intervene as a regulator in this market is whether there are externalities or not. And clearly here, what Anthony shows is that there are externalities. And the key externality is that this manipulation, because there is, you see this P minus psi, it's going to create some noise. It's going to increase the basis risk for the hedger, for the spot trader as well, by the way, but more importantly for us or for regulators, for the hedgers. And this is going to decrease the welfare of everyone, okay? And second externality is that whenever a trader tries to push the prices up, to manipulate the prices on the spot market, all the other speculators or spot traders may benefit from that. And so there are going to be strategic complementarities between the spot traders. Okay, and so because of these externalities, as a regulator, you may want to intervene in order to avoid manipulation. So this was the normative aspect of the model. The positive aspect of the model is that from the model, you can extract a measure, a proxy for the manipulation risk that is going to depend on some parameters that you can measure. Okay, so in the empirical part, Anthony is going to proxy some of the measure. In particular, for instance, he identifies exactly how many people are bidding in the auction. And so for other values that is going to estimate, you can have an idea of the manipulation risk. Okay, so it's a very nice paper. What is always tricky when you have theory and empirics in the same paper, or when you want to speak to a market failure and to regulators, is that you need to address all the comments on the theory, all the comments on the empirical part, and then you need to convince people that there is a link between either the theory and the empirical part, or what the theory is advising the regulators to do, and the reality of markets. Okay, so I'm going to focus on the third point. The key message of my discussion is that the results are very strong, I think, but they are undermined by some confusion and sometimes some inconsistencies between the assumptions of the model and the environment. So let me start with the first comment, and in order to introduce my first comment, I need to re-explain a bit what Anthony did very well, which is the final wealth of the different participants in the market. So you have a market with one risk factor, two assets that enable people to hedge against this risk factor, because the assets are actually correlated with the risk factor. Like a spot asset or underlying asset, and the futures, okay, for example, or any derivative. The pure trader, the pure hedger, it starts with an initial position. He's exposed to the risk side, and he has the opportunity to hedge by buying some contracts or selling some contracts on the derivatives market. If he buys, for instance, he's going to pay the contract price F0, and he's going to receive a payment at the terminal date of the maturity date of the contract. Now, in the model, you also have spot traders, okay, that I often call speculators. They have this initial position and they have a position on derivative, but on the top of that, they have the opportunity to trade on the spot market at the maturity date, with the objective of trying to push the prices in the direction of their profits in derivatives market. Okay, so there is thus an additional component to their wealth, which is what they get from the position on the spot market. Okay, that may be negative. And so if they buy the asset at the spot price ST, they are going to receive the consumption value of the good. Okay. So in this model, you see that if people do not hedge, on average, they have an expected wealth of 0, but obviously there is some variance. So they may buy or sell contracts on the derivative market in order to reduce their risk exposure. Okay. With the notation of Anthony's model, you have at the maturity date, the price, the futures price is equal to the spot price, which is equal to P, and P is going to be endogenously determined in the model in the auction. Okay. So my first comment is starts from the idea that in all the paper you mention market that you use the concept of market equilibrium in order to price the derivative security. Okay, and you motivate this by saying, well, the price of the derivative security at date 0, so when the people enter the hedge, so my F0, this is the fair price of the asset, and you simply say this is the expected value of the risk factor psi. Okay, and you motivate that by saying there is no aggregate exposure, no market power on derivative market, no information, everything is perfect. Normally, at least what I'm teaching my students is that this market equilibrium approach only applies to non-storable securities. Okay, the problem is that there is a confusion because most of the examples you have in the paper, they apply to storable assets, and your application applies to gold, which is a storable asset as well. And it makes a lot of sense to apply the model to storable assets because clearly there is going to be much fewer speculators on the market for non-storable physical goods. You cannot speculate on electricity prices on the spot market, because what are you going to do with electricity? You don't know. Okay. And indeed, in the market for storable securities, people take positions. Okay, so this is an example of a super contango situation back in 2011. We have exactly the same situation with the COVID crisis and China taking position in oil. So some people actually take position both in the derivatives and in the underlying assets. Okay, so normally I would have expected an approach of pricing the asset by arbitrage, okay, by cash and carry. The problem is that you do not allow spot traders to buy and store the good, okay, and you mentioned that it's because it's too costly, while we know that in reality some people actually do buy and store the underlying assets, okay, and in your model there is no arbitrager. Okay, so there is always this tiny question of, well, what if we introduce arbitrageurs in the model? Let me be clear. I think that all the results of the model are going to be robust to that, but somehow it's not clear whether you need only one friction that would be in perfect competition, or whether you would also need an additional friction that would be the absence of arbitrageur. Somehow you can avoid this discussion on market price equilibrium versus arbitrage by saying that simply, even with arbitrage pricing, if there is no holding cost and whatever, the price of the contract is simply S0. And so then there is a discussion of what should be S0. Is it the present value of the expected payoff of the expected risk? Is it the expected value of the consumption value? Is it the expected value of the price? So there is some necessary discussion here. It's not a big deal, but it's puzzling. Okay. Second comment, you mentioned quite a lot in the paper that your model applies mainly to cash set to. So you make a distinction between cash settlement and physical delivery. But if you look at my equation, so assume, for instance, that a hedger has a long position in the underlying. If he hedge with a contract that induces physical delivery, he's going to receive simply F0 minus the cost. If it's cash settled, then he's going to receive some cash and sell the underlying asset on the derivative market. So I don't really see any distinction here, except if there is an additional friction, which would be the fact that the hedger is going to receive the payoff at day T and only sell the underlying assets that is going to create the risk exposure at day T plus 1 or day T plus 2. Okay, so only if at day T prices are manipulated, but not before or not after. So there is a discussion on that in the paper, but it arrives very late. And I'm not completely convinced that it applies to your model. So you need to, if you want to make this distinction, in particular, if your application is what if the contract was cash settled relative to physical delivery, if you want to argue that this is the crucial point and not perfect competition, then you have to better explain that straight ahead. Again, it's not a big deal in the sense that there would be a way to circumvent that, but you need to clarify to convince people. Okay. Third point, there are strategic complementarities in the model that comes from the fact that you are happy if the other speculators push the prices in the direction that you want. This was clearly the case in the LIBOR situation, because in the LIBOR situation, all the firms usually what they want to pay is a fixed interest rate. So all the banks, they have an aligned position. They wanted to pay the float, so they had incentive to push the price in the same direction. This is not necessarily the case if there is not a natural hedging need from the producers or from the suppliers. Okay. And my last comment is going to be on the link between the model and the application. So you described the application very well. You are extracting data from the auction. You use the number of participants, the volume, the slope to estimate some parameters of the model. And then this enables you to run a counterfactual analysis. Okay. I have two comments on that. The first one is that the model predicts manipulation at the expiration date. And I think that in the empirical analysis, you are using all the days. Why, and is there any difference between expiration and the other days? Okay, first question. Second question, you mentioned that, so the action that you have is dynamic, the model is static. You view that as a limitation. Okay, in the paper, you try to extend the model to a dynamic setting in order to show that it's robust. But to me, it's not a limitation in the sense that you have a model in which there are strategic complementarities. We know that in the presence of strategic complementarities, it's going to ease the coordination to a collusive Nash equilibrium in the end. And so my question is, can you take advantage of the fact that it's a dynamic auction in order to show evidence of strategic behavior and potential coordination between the spot traders or between the auction participants? Okay, so conclusion. Obviously, there are always some clarification, simplification of the model and the assumptions that would be welcome, but it's a rich paper on a very important issue. And I really appreciate the fact that there are both these positive and normative aspects. Thank you very much.
All right, so thank you very much. I have currently a little bit of a tech problem because I can't figure out how to enable the raise hand function. But maybe at this juncture, it would be a good idea if Anthony could respond to the first question, the Q&A. You may or may not have read it, but let me read it out to you. So should the question as to whether market manipulation, and not only in the derivatives markets, but in securities markets in general, should be regulated, banned, or be boiled down to an empirical analysis? This assertion, in my opinion, pioneered by Fisher and Ross and further bolstered in law and economic scholarship, strips the law of its normative complexity and gives rise to the impression that market manipulation is ethically okay. Do you agree that banning market manipulation, even if it has a negative economics value, might also have a useful deterrent effect?
So that's, I think, a very good question, a very hard question. I think I have answered on two levels. So one is a practical level and one is a more philosophical level. So on the practical point, I think the stance that I push in this paper, I think is purposefully, I think, somewhat a bit extreme. And I think sort of outside of the paper, I think a more sort of in-between approach might be better in the following sense. So in antitrust regulation, you have basically a mix of behavioral and structural regulation. So collusion is sort of bad and punished by catching people and saying this is bad, don't do this, and fining them. And other offenses are largely regulated structurally. So that's my understanding. And it seems to me that one could do something similar in contract market manipulation, and sort of the economic nature of the problem makes it so you should at least, regulators should at least pay some attention to structural features. Sort of finding lots of money in markets which don't seem manipulable seem sort of potentially to create inefficient sort of uncertainty for market participants. And also in a world where regulators have finite resources to go after things, just knowing which markets are likely to be problematic seems to help direct that scarce regulatory attention. I think from a more philosophical perspective, I think one could debate whether, so that's the policy answer, that I think you want to do something in between. And it seems in the manipulation case in particular, there seems to be relatively literal structural approaches happening. And I think that's largely because we don't have an understanding and we don't have tools. The idea is sort of, if we have a better theoretical understanding and more tools, at least we could help do that bit. From a philosophical perspective, I think a question which is beyond the scope of this paper is market manipulation bad in some ethical sense? And sort of, is there a sort of normative outside of model or welfare analysis reason to say it's bad? And I think my hesitation there is that it seems so hard to define what this thing is, that sometimes using price impact in a certain way is bad for markets, that I wonder whether there is an internally consistent way to define sort of bad kinds of price impact outside of a welfare-based model. I don't know if that kind of gets at your question. And sort of, I guess I'm leaning a bit towards it doesn't look to me from the cases I have read that this can be defined in a sort of logically tight enough way that that the behavioral approach works very well in this setting. So those are sort of the two layers of my answers, if that makes sense. Yeah.
All right, thank you, Anthony. Sorry, I should also say I'm really sorry. Sophie, many thanks for your very insightful discussion. I forgot to actually give you a proper thank you early on. I've now enabled and worked out how to enable the raise hand function. The next question will come from Cameron.
Hi there, Anthony. I really liked your paper. Also, Sophie, great discussion. But so when I was kind of going through this, there's this Kang paper, Kang, Ronworst, and Tang paper that came out in the JF this year. And so basically, one of their findings was that commercial traders who can trade in the spot market tend to receive this premium from speculators, right? They get paid to provide liquidity in futures transactions. And it seems that they actually find what I think is a pretty significant magnitude of liquidity provision premium. And it seems to me that that's consistent with your story, right? But in their case, it was more of, hedgers have this capacity to provide liquidity so they can just do it. Whereas in your case, it's more that it's a manipulation thing. Do you have an idea about the relative magnitudes in profits that accrue to spot traders from manipulation versus just the fact that they have the ability to transact in the spot market, so they get compensated for that?
Yeah, very good question. I have not thought through that in a lot of detail. I think sort of the approach one could take is, to the extent that one can estimate the metrics in my paper, one can basically subtract those profits from the profits I predict, and that would be a way to decompose it. I think that another empirical approach one could take is that it seems that sort of, again, my model is not dynamic, so I'm not totally sure about this, but it seems the pattern of trading that would suggest most of these profits are manipulation versus most of these profits are sort of harvesting a risk premium are slightly different, in the sense that manipulation is aggressively trading a lot, very close to settlement, whereas the sort of gathering a risk premium explanation would involve buying the contracts at a relatively sort of distorted price and then sort of slowly, with low price impact, diffusing that in the spot market, if you see what I'm saying. But sort of those would be my guesses as to how to do that, but I haven't sort of, in no sense are those formalized guesses. Yeah.
Cool, thanks.
Thanks.
So I have a question which came by email from Pete Kyle, who watched the YouTube stream. If you apply your model to the Hunt brothers cornering of the silver market in 1979 to 1980, does it imply that the silver dealers, not the Hunt brothers, were the manipulators because the dealers did not arbitrage away price discrepancy that they could have arbitraged away? Instead, the dealers limited their long-term positions to make their arbitrage trading more profitable. Was the Fed a co-manipulator because it discouraged banks from lending against silver collateral for the purpose of limiting arbitrage, which enabled the Hunt brothers to purchase more efficiently?
Let me think about that question for a few seconds. I think that, to slightly dodge the question, my model is sort of, in the context of my model, if you hold an epsilon amount of a derivative contract and have a non-zero capacity to trade in the spot market, qualitatively speaking, you are a manipulator, in the sense that sort of there are trading incentives you have in the spot market which are attributable to your manipulative incentives, i.e. you want to increase profits on your spot market. So I think sort of the only internally consistent way to answer that question in my model is yes, sort of qualitatively, all of these would count as manipulators or co-manipulators. Now, I think sort of if you take the kind of structural approach really seriously, then you could say everyone who is in this kind of position has an incentive to manipulate, and sort of you should recognize that incentive, quantify it, and design markets in a way that they're competitive enough that the incentive doesn't distort market outcomes so much. I think it's a very good and useful question because it kind of illustrates that if you take a broader view of who could profit from price movements and who could trade in the spot markets, then the definition of who is a manipulator under the CFTC's current approach, which is that if you trade with the intent to move prices and profit on your contract positions, you are a manipulator, is an extremely broad umbrella. So I think that would be my answer. Yes, they are manipulators, but sort of the more normative and sort of fuzzy part of my paper suggests maybe the most effective way to combat this is not to throw all of them in jail or fine them a lot of money, but to sort of tighten the position limits and sort of try to tighten position limits and to the extent possible try to make spot markets more competitive. Yeah.
And thank you for that answer. So now, as our usual protocol would say that by now, at this point at noon, the official part of the presentation is over, but both Anthony and Sophie agreed to hang out for a little longer. I would like to thank everybody who has stayed on for so long, and we're going to keep chatting now. Xiaoyun, you would be the next person to...
should I answer Peter Lerner's question? That's been in the chat.
Well, I was about to say that, Peter, if you want to ask a question live, you could also raise your hand. I'm not sure if Peter's still actually online, but maybe we can first have Xiaoyun talk, and then Peter can chime in if he wants to.
Hey, Anthony and Sophie. So I've got two quick questions. First one is, in the model, if you allow free entry into the spot market, let's say by traders who has no derivatives contract positions, they see that there might be arbitrage opportunities in the spot market. Would that reduce or eliminate manipulation in the model? And second question is from a regulator's perspective, if they require a China wall between, let's say, the derivatives trading desk and the spot trading desk, would that make manipulation more difficult and maybe more easily they can be caught more easily? Thank you.
Oh, yeah, thanks. For the first question, if there's costless free entry in the spot market, then for all intents and purposes, the slope of aggregate demand is infinite. So then there's an infinite number of participants and nobody can move prices, so you can't manipulate. So you can see this in the model as n goes to infinity. So this is related to Peter Lerner's question also. People bid competitively and there's no more manipulation. So you're correct that sort of costless free entry kills manipulation. If you look at the CFTC commitments of traders, I've gathered some data on spot markets. The number of participants in a given market seems to range between sort of 3 and around 20 to 30. So sort of 20 to 30 is large, but not infinite. And sort of this seems to be even true and perhaps even more true in some of the financial asset markets, repo and FX markets, for example. So empirically, my view is that n is not infinite. Yeah. And then the second, sorry, could you remind me what the second, oh yeah, the Chinese wall approach, right? That could work. I think that's kind of, my view is that seems to be what the current regulators are trying to do, which is you can hold both, but these can never talk to each other. Sort of, if you believe that works well and there is never any communication, yes, that would also cancel out the negative effects of manipulation. Now, the fact that there are a lot of cases in which there wasn't a Chinese wall seems to suggest that sort of it doesn't work that well in all cases. But yes, sort of that would be another approach that could sort of, if it worked, cancel or reduce the negative effects. Yeah.
Thanks.
All right. Does anybody else want to raise their hand? Or Anthony, I mean, you've touched upon Peter's question already. Do you want to? Is there something that you want to add on that front?
I'll just elaborate briefly. What the factor t is doing is t equals 1 when you perfectly hedge. And so when n goes to infinity, everyone acts effectively competitively. and then the price is the perfect signal is the risk factor. So everyone perfectly hedges, and it converges to the competitive outcome. So that's the way to intuit what's going on there. If that makes sense. Yeah.
Okay. Do we have anybody else? Oh yeah, Mao. Mao, go ahead. Oh, Peter. Oh, Peter, you know what your hand. Do you want to? Okay, I'm just going to enable you to talk, so you can elaborate if you want, but you would have to unmute yourself. There you go.
I suggest that if you had a kind of improvement of the model in which you have traders with market power, if you have traders with, even in the case of infinite amount of traders, if you have traders which have market power, it seems, or they take or sell finite fraction of all orders, then it seems that manipulation is possible even in very large traders market.
So in my baseline model, I assume everyone's symmetric, so n is a sufficient statistic. In the generalized model, I allow traders to be asymmetric in terms of their risk capacities. So I haven't done the limit, but I believe what you're saying is correct, that if we have an agent with capacity 0.5 and an infinite amount of agents whose capacity collectively is also 0.5, then the large trader has market power. So I agree, yes, in general, n is not a sufficient statistic. You have to account for the differences in effective trader size. And my generalized model somewhat captures that, though I didn't do.
Thank you.
Yeah. Thanks.
Thank you.
Thanks.
Okay, Mao, you're next.
Okay, thank you, Andrews. And Anthony, this is a very nice paper. Can you hear me, by the way?
Yeah.
Okay, I have a very minor point. It's like, it's like, have you think of like add more markets in your empirical analysis? Because I noticed like you motivate your study using natural gas, but finally your empirical analysis is using the gold market. It's like, because my impression is like, at the beginning you say the natural gas have a very small like a spot market and a very large derivatives markets. I think it's like you probably need to look at more markets like have that characteristics. It's just a minor point.
Yeah. No, it's a really great point. I actually had some of that in a previous version of the paper. It got too long, so I cut it out, and I'm some of that I'm hoping to do in some future work. You're correct that if you look at the natural gas ratios, the liquidity mismatch is absolutely massive for some of the gas basis swaps.
So how about gold? How about gold? Is like gold mismatch is also big or no?
Gold mismatch is both not so big. Yeah, gold mismatch is not so big. The idea is that the biggest position you can hold is around 300,000 ounces versus the auction trades 170,000 ounces. So
yeah.
so sort of 300,000 per person, right? So then basically the mismatch is around a factor of around 10.
Okay, then that actually you have a hypothesis to test. Basically, it's like this type of manipulation is a function of mismatch.
Yes.
Right. Using gold, you actually don't find many manipulation. But if you change that to natural gas, you might find more manipulation. So then it's like a result. It's like basically, I think probably one of the main mechanism in your like motivation slides is it's a function of mismatch, right?
Yes, exactly. Sorry, mismatch and competitiveness.
Okay.
Yeah, I totally agree. That's I'm trying to do that in slowly ongoing work.
Okay, thank you.
That's precisely, you can actually predict if you look at a market whether this should be manipulable using a fairly simple ratio in the simple case of the market.
Yeah, that's for your next paper, I think.
Yeah. We'll see. The data is surprisingly hard too, because you would have to get data on the spot market, and the contract market you get like fairly uniform, good quality data, and the spot markets I have had to basically go case by case and gather like physical gas trading data. So that's the sort of operationally difficult part. But yeah, it's a natural next step.
Yeah, great. Thank you for all that.
Does anybody else want to ask a question and raise their hand? Nope, nothing is coming. So I want to thank both Anthony and Sophie, and of course all the attendees who stuck around here. I apologize for my little tech issue in the middle of it. So I think this is it for this presentation. Thank you, everybody, and I'll see you all next week.
Thanks, everyone.
All right, bye-bye.